Good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're here to talk about a topic that I think is very important in terms of helping investors gain more consistency and gain more confidence in being able to grow your account in a sustainable way. So today what we're going to discuss is a single strategy that I think is at the core of what every options trader needs to learn in order to, like I said, gain more consistency in your trading. Now, how many of you here are currently trading options and maybe finding it a little hard or difficult to be consistent in your trading? If you feel like that, please type yes into the chat window right now. I just want to get a sense for the audience here for the room. Okay, I see a lot of yeses. And this is, from my experience working as a strategist for the past 16 years or so, the one thing that I see most retail traders struggle with, it's how to find consistency. So today what I want to discuss is a single option strategy that you can use to gain more consistency, and more importantly, how you can leverage the tools that are available to you here at First Trade to be able to implement what we are going to teach here today. So before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So like I said, on today's agenda, first thing we're going to talk about is growing a small account. Now, what we're going to discuss here today is not only applicable to small accounts, it's just more important if you have a smaller account to follow the rules that we're going to state here today. Then we're going to talk about the credit spread, a vertical credit spread, which is the single strategy that I want every investor, doesn't matter whether you're brand new to options trading or you're an experienced options trader, to spend some time to learn and to master. And we're going to talk about the optimal strategy, the optimal credit spread, the best practices for trading them, and we're going to go through a few trading examples to help you better understand the strategy. And hopefully after today's session, you'll have a pretty good grasp of the strategy itself. And then what we're going to show you is how to access the actionable signals that we have recently just launched for First Trade investors so that you can find ideas like the one we're going to show you here today on a daily basis using the tools available to you here at First Trade. Then we'll talk a little bit about the four rules for trading that will really help you build your confidence and build on what you've learned here today. So let's go ahead and get started. But the primary question that I want to help investors answer from today's session is a clear understanding as to what strategies should I focus on in order to grow a small account sustainably using options. There are lots of other strategies that you can trade. There are other asset classes that you can trade. But what we're here to discuss is how can we grow your account sustainably? And this is the strategy we're going to discuss here today. So my name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And I want to share with you the tools that we recently just launched for First Trade investors that can help you achieve this one goal. So let's first talk about what we want to learn today. And this is really regarding around how to grow a small account or an options account sustainably. The first thing I want to make sure we understand today is simple and repeatable steps that you can take away from today's session that you can apply to your trading account going forward. The second thing I want to help investors learn today is how to build more confidence. And this is really by winning more than 50% of the trades that you place when you trade this particular strategy. Now, the one thing I will point out is that if you're starting out and you've never traded this type of strategy before and you're just testing the waters, you might find that you might win more than 50% of the time, but you may not find yourself just yet profitable. You may find yourself on the verge of just breaking even on your trades. And that's okay. I think investors that if you win 60% of the time, but then you end up breaking even, that's enough to get you started because you're not losing any money. You're trying to just get yourself to break even. And then once you get to break even, you can then work on optimizing and becoming profitable. But I think most people struggle even to get to break even. So the first goal here is to get you to break even, get you to win more than 50% of your trades, and get you to feel confident about what you're doing and feeling that you have a strategy that you can rely on. And then most importantly, The third thing is for investors to have a clear understanding of your risk and rewards. I cannot speak enough as to how many times I see investors trade options not knowing how much money they can potentially lose, not knowing how much money they can potentially make. And what they're doing is once they're in the trade, they're kind of figuring out as they go along. They're trying to figure out, when do I take profits? When do I cut my losses? Because they didn't figure this stuff out before they get into the trade. So the strategies that we'll discuss here today give you clear risk and reward, so you know exactly how much you can make or lose, and you know exactly when you're going to get in and when you're going to get out. Does that make sense? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so let's talk about this one strategy that's called a credit spread. Some of you may have heard of credit spreads. Some of you may have traded credit spreads. Some of you may never have heard of this before. Doesn't matter which camp that you're in. Today, we're going to give you a full lesson on credit spreads so that you can understand how to use them properly. Even if you've traded them before, I encourage you to have an open mind about how we approach credit spreads that may be a little different than how you're currently trading credit spreads. And most importantly, we want to show you how to find credit spreads where you have an edge. This is how you can get from break even to profitability. So even if you have traded these strategies before, please bear with me. So what is a credit spread? We're not going to get into the details of a credit spread just yet. What I want to talk about is, what do you get out of a credit spread? Number one, it's what we call an income generating strategy for a mild directional view. What do I mean by mild directional view? It just simply means that any stock where you have a general idea of the general trend. You don't need to have a specific view. You don't have to believe that the stock is going to move 5% in 10 days, or you think it's going to move down by 30% in the next 3 months. Those are specific views. And there are certain strategies that are really good for when you have a specific view. But there are many times where you don't have a very specific view. You can just see that the chart is trending in one direction, and that's really all you know. Well, for those types of strategies, that's when you may want to use a credit spread. The second thing about a credit spread is that it's a forgiving strategy. We're going to talk a little bit about what that means. But essentially what that means is that if you get the directional view right, you'll be profitable. But if you get the directional view wrong, you can still be profitable. And this is something that's kind of confounding for some investors as to how that's possible. But that truly is a strategy. There are some trade-offs with that, but it is a forgiving strategy, and it does give you a higher probability of success. And this is really just going to help you build your confidence, help you feel that you have something that you can build upon. And then lastly, it is a strategy that has limited risk and has limited reward. What that means is that every single trade you get into, before you get into it, you'll know exactly how much you can make and how much you can potentially lose. This way, nothing's going to come as a surprise. You're not going to get into a trade and then realize that, hey, I'm not sure what I'm supposed to do. You know exactly what to do before you get into a trade. Does that make sense? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, so now that we understand credit spreads as a general sense, let's talk about a specific example, right? And I always think the best way to learn is to look at a specific example. So let's look at LI Auto, a Chinese EV electric vehicle producer. General uptrend, right? That's all I know. I don't really know much more about it. You don't necessarily need to know the fundamentals or the technicals. You can kind of just look at a chart and see that it's in a general trend. And you can also use the OptionsPlay trend indicator to give you a sense for where the stock is currently moving in an overall trend. So before we get into the mechanics of a credit spread, I'll just give you an example of a credit spread that you could sell when you've identified a stock that's moving in a specific general trend. Okay, so we're going to look at a bullish credit spread example. In this particular case, we're going to go out to September 17th, the September expiration. And what we're going to do is we're going to sell the $30 put. So notice how we're selling a put option that's at the current price of the stock. So $30.50, we're going to sell the $30 put. And then, however, for those of you that may have experience with selling a put option, you know that when you sell a put option, if you are right on the directional view, you can make money. But if you're wrong on the directional view, you can lose a significant amount of money. because if the stock keeps moving lower and lower and lower, you will lose more and more money. And not to mention, you need a lot of capital to sell a put option. To sell a $30 put in this particular case, you're going to need about $2,700 of cash to sell a single contract. And not everyone always has that type of cash laying around. So there's two things that we can do to reduce our risk, or there's one thing that we can do that not only reduces our risk, but also reduces the amount of capital that we need to get into this trade. And that is to simply buy a lower price put. So let's say we buy a $25 put, and here we collect $3 for the $30 put, and now we pay $1.10 for the $25 put. And what that gives us is a risk profile that looks like this. If the stock moves higher, we make money. If the stock moves lower, we start to lose money. But at a certain point, we stop losing any more money if the stock keeps going lower and lower and lower. And that becomes the limited risk to reward nature, if you will, of credit spreads. And just to go through three important numbers that you need to understand when you're selling credit spreads: the max risk, max reward, and break-even cost. So your max reward is simply the difference between what you collect when you sell the $30 put for $3 and what you have to pay to buy the $25 put. So if I collect $3 and then I pay $1.10, the net difference between those two numbers is $1.90. So that's why my net credit on this trade is $1.90. Now, because each option contract is for 100 shares, that's how I have a max reward of $190 on a credit spread like this. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Okay, so that's how we calculate max reward. It's simply just how much you're collecting, or the difference between what you're collecting and what you're paying. Now, what's your max risk? Well, this is also a fairly easy calculation. It's not intuitive, but it's an easy calculation. What you do is you take the difference between the two strike prices. So I've sold the $30 put, and then I buy the $25 put. That's a distance of $5 in between those strike prices. And what I have to do is I have to subtract the $1.90 from the $5 that of the credit spread. And what I get is remaining $3.10. So if I subtract $1.90 from $5, the rest of it, $3.10, that's what my max risk is. So that's how you can calculate very easily how much can you potentially make and how much can you potentially lose. You're really looking at the difference between what you're paying and collecting and the distance between the two strikes. And between those numbers, you can calculate your max risk and your max reward. Does that make sense? Please type 4 into the chat window if that makes sense to you. Okay, so and here's the thing, is that I'm just telling you the mechanics of how to calculate it, but the platform does all the work for you. So you don't have to actually do these calculations. I just want investors to understand this concept, because we're going to come back to this later to discuss what are optimal credit spreads, or how do you find credit spreads that give you an edge. And the last number we want to look at is the break-even cost. The break-even cost just tells you where does the stock need to stay above in order for the strategy to be profitable. And this is really what you do, is you take the $30 put and you subtract the $1.90 from it, and you get $28.10. So remember, this is a stock that we're bullish on, meaning we think the stock is going to go higher. But this strategy is profitable as long as the stock stays above $28.10. And that's a forgiving nature of this strategy. We're going to explore that here in 1 second. But it's important that you understand these three numbers: max risk, max reward, and break-even cost. Okay? If everyone understands that, we're going to move on to the next slide, where we can take a look at actual outcomes. So if we were to deploy a credit spread on a stock that we're bullish on, what will actually happen if the stock moves higher, if it moves sideways, and if it moves lower? And this is really where I think credit spreads is interesting for a lot of investors, because there are three numbers for us to pay attention to: $30, which is the strike price that we've sold; $25, which is the strike price that we've bought; and then $28.10, which is the break-even price of the strategy. So remember, this is a stock that we're bullish on, right? So maybe we think the stock is going to head back higher towards 33, 34. Well, as long as the stock stays above the upper strike price, the $30 put price that I've sold, I'm going to make my full $190 profit. I know exactly how much I can make if the stock stays above 30, right? So if I'm right on my directional view, I make the $190 profit. I think that's pretty simple for most investors to understand. But what happens if the stock doesn't move higher and just moves sideways? Well, if it moves sideways, it's still technically above $30. So if the stock doesn't move any higher, I still make the full $190 profit. So this is where it starts to get really interesting, right? Because I could get the directional view right, I can make money. If I don't really have the directional view right or wrong, I still make the money, and it gets even a little bit better. Because if the stock goes against the directional view that I expected to, but moves just a little bit lower, let's say it moves down to $29. It's currently trading at 30.5, and the stock declines to $29. Well, guess what? You've got the directional view wrong, but because the break-even cost is $28.10, if the stock is between $28.10 and $30, you still make some profit. You just don't make the full $190 profit, but you still can make a profit. And that is the truly forgiving nature of a credit spread. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, so now let's talk about what if we just flat out get the directional view wrong, right? So in all these cases, I was thinking about, well, what happens if I get the directional view right? But now what happens if the stock just continues to climb, right? So you see the stock moved higher here, started to move lower. Let's say it doesn't continue on and it just starts to move lower, right? If it does that, well, if it ends up somewhere between the lower strike price of $25 and the $28.10 break-even price, I will lose somewhere between $0 and $3.10, or $310. Basically, if it's at $28, if it's, whoops, one second, let me change my colors here. Basically, if the stock was to decline to $28.10, I would basically lose 0. If it declines further and further, all the way down to 25, I'll lose $310. So depending on where I land between $25 and $28.10, that would determine roughly how much money I will lose. So it'll be somewhere between $0 and $310. However, if the stock was to really plummet and decline down to $20 or $15, or just significantly moves lower, like we've seen on some Chinese technology stocks here, well, no matter what happens, even if the stock goes to 0, the most I can lose is the $310. I cannot lose more than the $310. And that's what buying that $25 put protects me from if this stock just falls apart and I have a significant move to the downside. I limit my losses here to just $310. Does that make sense? Please type 6 into the chat window if that makes sense to you. Okay, so if this is your first time, you might find it a little bit tough to kind of keep up. Don't worry, you can watch the recording and kind of follow along and make sure you fully get it. But for most investors that have traded some options, these should be concepts that you understand, that you might want to come back and just review. But this is at the core of what a credit spread is. So when we talk about credit spreads, in this particular example, I told you which expiration and which strike prices to sell. So if you were to do this on your own, if you had a stock that you were bullish on or bearish on, how do you determine the optimal credit spread? And this is really where the rule of thumb, based on our backtesting over tens and tens of thousands of trades, is pretty clear that the optimal credit spread is to go out roughly 45 days to expiration, and then you want to sell an at-the-money call or put. So for a $30.54 stock, that's why we sold the $30 put. We basically sold the first put that was out of the money, the closest put to the current price of the stock. And then what we want to do is we want to buy an out of the money put. We want to buy a put that's further out of the money. Now, if you're selling a bearish credit spread, you would sell calls and then buy a further out of the money call option, but you always want to use what we call a 25 delta. Now, our platform will show you the strike price and what the delta for each strike price is, and I'll show you that here in 1 minute. But basically, a 25 delta strike price is a strike price that there's only about a 25% chance that the stock will be below that price by expiration. So when we talk about a $25 strike price, that means that there's only a 25% chance that the stock will be below that price by expiration. We always use a probability-based approach to trading a credit spread. Now, here's the key. The key to all of this is that when you use these types of expiration dates, strike prices, that in itself is not enough to choose to sell a credit spread. What you absolutely need to have is you need to collect at least 1/3 of the width, meaning the distance between the two strikes, in this particular case, between 25 and 30 is $5 wide. And you need to collect at least 33% of that. So if you take $5 and you multiply that by 0.33%, you'll see, that's $1.65, which means that if you're selling a credit spread that's $5 wide, you must collect at least $1.65. In my example here, I collected $1.90, which is more than $1.65. That's how I know that this is a credit spread that I want to trade. If you ever come across a credit spread where you sell the at-the-money strike price and you buy the 25 delta, and the credit that you're receiving is less than 33% of the width or less than 1/3 of the width, that is not a credit spread that you should trade. That is the minimum that you need to collect. Now, I will get into why that is the case but before I move on and talk about why, I want to make sure everyone understands that. So please type 7 into the chat window if that makes sense to you. Okay, so, and for those of you that are trading in a small account, what you generally want to do is you only want to sell credit spreads for stocks under $50. You don't want to go for, I don't know, Roku or Tesla or Apple, $100 stocks, $200 stocks, $400 stocks. You do not want to sell credit spreads if you have a small account. So if you, you do not want to go for stocks over $50 if you have a small account. So stick to the lower price stocks if you have a small account. If you have a larger account, you can trade just about anything, okay? But when you have a small account, make sure that you use stocks that are lower priced for this. And I'll show you how to find those things as well. So let's talk a little bit about why 1/3 is the rule for selling credit spreads. So in our example, if we sell the $25 put, and then let's say we buy a $20 put, the distance between those two strikes is $5, right? And I was telling you how if you collect 1/3 of the width, that is the minimum that you need in order to sell a credit spread. Why is that the case? It's because of what we learned in our first slide. Because whatever you collect in income or whatever your max reward is on the trade, the rest of it is going to be your max risk. So what you want to do is you want to make sure that you have a minimum amount of income so that you can cap the maximum amount of risk. Because if you collect 1/3 of the width, that means 2/3 of it is your risk. So on every single trade, for every $1 you can potentially make, you're going to risk $2 on the back of that. A lot of investors will say that sounds like a negative risk reward ratio, and the answer is that it is. But remember, you have a favorable outcome. You have a higher than 50% chance of winning. This strategy actually requires you to be winners 67% of the time in order to be profitable. So if you win 2 trades at $1 each, and then you lose 1 trade at $2, you win 2 trades at $1, lose a $2 trade, win 2 trades for $1, lose 1 for $2. If you do that over and over again, what you end up at break even. So in the very beginning, I said that if this is your first time doing this, just shoot to break even. Just shoot to not lose any money. If you can do that, you're already a good step towards sustainably growing your account. This is the minimum that you need to shoot for, because if you have a worse risk reward ratio, it's going to be difficult even just to break even. But with a 2-to-1 risk reward ratio, many times you can at least reach break even or just shy of break even on your strategies. And that certainly is a lot better than feeling that you have no consistency and you're losing money over and over again. Does that make sense? Please type 8 into the chat window if that makes sense to you. Now, trust me, my goal here is not just to get you to break even. My goal is to help you get to profitability. So let's talk a little bit about how we actually go from breaking even to achieving profitability. And it comes from what we call finding an edge. What that means is that sometimes you're going to find that when you sell a $5 wide credit spread, where I sell the $25 put, and buy the $20 put, which is also a $5 wide credit spread, that instead of just collecting $1.67 or $1.66 on a credit spread, 1/3 of the width, you tend to find that some of them you're able to collect a lot more, like $2, which is about 40% of the width. And going from $1.67 to $2 doesn't sound like a big shift, but remember, for every single cent you increase your income by, you are also at the same time reducing your risk by that same amount, because whatever you collect in income, the rest of it is your max risk. So if you're able to collect 40% of your vertical spread as a credit, for every $1 you're risking, for every $1 you're making, you're only risking $1.50 on the back of that. What that means is that if, let's say, you have 2 trades that you win $1 for, and then next trade you lose $1.50, you win 2 trades, you lose $1.50, you win $2, you lose $1.50. Well, guess what? Over the long run, that's going to be a profitable strategy for you. And that's what we're all trying to strive for. Does that make sense? Please type 9 into the chat window if that makes sense to you. So if everyone understands this, that brings us to the $1 million question. How do I find strategies that collect 40%, 38% of the vertical width, as opposed to just collecting the minimum 33%? And that's where the launch of the new credit spread opportunity report that we just added to the options research and tools and options comes into play. Because what we do here is we actually sort based on how much of the premium you're actually collecting as a percentage of the vertical width. So you can actually find trades that give you that edge. And not only do we look for opportunities that give you an edge, we also scan for a few other things that are very important for options traders. The first thing we scan for is liquid optionable symbols. We throw away about 95% of optionable symbols because out of the 44,000 symbols you can trade options on, the vast majority of them have very wide spreads. There's not a lot of volume in them, so it's just not something that it's easily to trade in and out of, at least at a fair price. So what we do is we give you options that you can generally buy and sell within a cent or two of the midpoint. So we already scan for options that are very liquid. And then what we do is we filter out all the trades that collect less than 33% of the width and only show you the ones that generate more than 33% of the width. So if you look at Roku here, 39% of the width, XLI, 40% of the width, Airbnb, 37% of the width, Peloton, 37% of the width. We're going to take a look at a couple of these trades here. And as you can see, this was generated just a couple of hours ago. So not only does this give you everything that you need in terms of the symbol, whether it's a bullish or bearish idea, all the details that you need, such as, whether it's a call or a put, the strike prices, which strike price you're selling, which strike price you're buying, the expiration date. We give you the premium as a percentage of the width, so you know how much of an edge you get. You also have IB rank and earnings dates, so you know which ones are about to report earnings. And then I'm going to show you this trade button here in a second to show you how you can basically take an idea and execute these trades immediately. But this is really where this new tool that we just recently launched for all first trade investors, like I said, you can find it under research and tools under options. And it's the credit spread opportunity report. I usually like to sort it based on the premium percentage column because that tells me where I have the most edge. Now, I'm going to stay away from Roku because it reports earnings today, so I don't think that that's a suitable trade right now. But if we look at Peloton, let's take a look at Peloton. This is telling me Peloton's currently trading at $120. So it's telling me to sell the 120.105 September 17th. So let's take a look at that. I'm going to bring up OptionsPlay. And as you can see, I already have this up for you so that we can quickly analyze this. So what I'm doing is I'm selling the September 120 put, and then I'm buying the September 105 puts. So as you can see here, I'm collecting $5.90 for a credit spread that's $15 wide because the distance between 120 and 105 is $15. And the difference between these two premiums that I have to collect versus what I'm paying is $5.90. So let's do a little bit of math here. $5.90 divided by the $15 that the credit spread is currently, the distance between the two strikes, that's where I'm collecting 39.33% of the width. So just a bit shy of 40%. So I'm actually I have a fairly huge edge on this particular trade. And this is really where you as an investor can then look at the chart. You don't have to do any more research on the options trade. You can look at the chart. You can say, is this stock trending in the right direction? Is it trending higher? Maybe you think it's going to break out from this resistance level and start to trend higher here. Maybe you might think that, no, this is heading lower. And if that's the case, maybe this is not the trade for you. But this is really where you can look at the chart, you can look at the fundamentals, and you can make a decision. Is this the trade that I want to make? If it is, you can hit the trade button and you can preview order, and that's going to pre-fill the order ticket for you using exactly the strike prices that we've shown you here today. Or you can simply click on the trade button here on the report, and that will also pre-fill the order ticket for you based on the current price of the options. So this is designed to really help make your trading as easy as possible. Number one, help you find these opportunities to begin with that we just taught you here today. How you can find trades that have an opportunity or an edge, how you can analyze it using OptionsPlay. And we can go back to this and we can take a look at another trade here as well. Let's just look at another trade just for argument's sake. Let's look at this Roku trade. This is also a bullish trade. Roku is a high price stock, so this is not for everyone, right? So this is telling me to sell the 415,370 for September 17th, 415,370. So let's take a look at that. So Roku is currently trading at 420. This is telling me to look at, and you can use our strategy constructor to use and select bullish strategies, short put vertical, to quickly look at a put vertical here. This is the September. We said the 415, 370. And as you can see, this collects $17.70 for a $45 wide credit spread. So this is an expensive one, right? Not everyone is going to be able to trade this. And I'll go through one more example that's maybe a little lower price. But $17.70 out of a $45 wide credit spread is also 39.33%. So I'm collecting just a bit shy of 40% of the width. And I can look at my chart and say, do I agree that this stock is trending in the right direction? And not only are we scanning for opportunities, we also look at the direction when we post these trades. And what we generally are looking for are stocks that are sort of oversold in a longer term bullish trend here, which is exactly what Roku is, right? Because what we want to do is we want to identify setups similar to this, right? And that's exactly what we're seeing here, is that perhaps you are going to start to see a move higher here. Those are the technical things that we're also scanning for in the background. But it's always good for investors to just have a sanity check on these things, because these are computers doing the work, right? There are some things that computers will always miss. So it's always important that you do your own research, both on the technicals, on the fundamentals. Make sure you agree with our directional view. If you do, then you can go ahead and hit the trade button, preview order. That'll pre-fill your order ticket within first trade, or you can simply click on the trade button here on your credit spread report. And when you click on that, that will pre-fill the ticket for your trading, and you can immediately enter this trade for, let's say, a $17.67 credit, which is the midpoint here. And like I said, because we've already scanned for liquidity, you usually don't have to go more than a couple of cents off the midpoint in order to get a fill. You don't have to move your orders all the time. You shouldn't have to work these orders to get filled, because these are highly liquid stocks that we are already scanning for you based on these opportunities. So let me see if I can find a lower price stock here. So GDX. So GDX doesn't, let me first sort by premium here. So KRE. This is a bearish trade here, okay? And this is your call to decide whether you agree with this bearish view here, but this is a bearish trade, and we're selling a call vertical here. So let's take a look at this one. We're selling the 63.67 September call option on KRE. So KRE is the regional bank ETF. Let's take a look at this. Here we go. This is the chart. As you can see, it's been recently on a downtrend, and recently it's had a bit of a rally here. So what we're really searching for are stocks that maybe are near the top end of the range and maybe start to continue to decline. And maybe you disagree with this. Maybe you think that this is already starting to show some strength here. Maybe you think it's going to go higher. Maybe this is one that you'll walk away from. But I just want to show you this trade for those of you that are interested in taking a look further. You can use our strategy constructor. This is a bearish trade, so you would use a bearish short call vertical. And we were looking at selling the 63.67, I believe. And notice here, right? If you were to manually select these strike prices, I mentioned before that what we're doing is we're selling the at the money strike. So when the stock is trading at 62.5, the at the money strike is a $63 call option. And then I mentioned that we're going to buy a 25 delta call or put. Well, that's exactly how we selected the 67 strike, because as you can see, the 67 strike is the 25 delta put. I'm sorry, 25 delta call. And that's why we chose this very specific price, because what we're saying is that based on option premiums, there's only a 25% chance that KRE will be above 67 at expiration. So that's why we chose the 67 strike. But as you can see here, if I were to sell this 63.67 call spread, I'm collecting $1.47. Now, this is $4 wide. The difference between 63 and 67 is $4. Here, I'm collecting $1.47. So let's do a little math here. 1.47 divided by $4 is 36.75% of the width. So this gives me an edge, but not as big of an edge as I did in Peloton and Roku. But that's okay. Not every single trade is going to get you 40%. But the whole point is to try to get some trades that you or every trade to have more than 33% of the width, because that's going to give you that edge on these types of trades. And again, if you agree with this trade and you look at the technicals and you say, hey, this is an ETF that clearly was in a bullish uptrend that has now turned bearish, and I think it's going to continue moving lower, then this is a bearish trade that you can potentially make here on KRE. And then you can either hit the trade button and hit preview order to fill your order ticket, or like I said, again, you could simply find the trade on the credit spread report, and when you click on it, it will actually pre-fill your order ticket for you on here, and you can simply enter the trade here at a net credit of, let's say, $1.46, which is what we just saw before on the previous screen. So hopefully this gives you a good sense for how you can take what you've learned here today and not just take it from a conceptual and theory perspective, but show you how to apply it using the tools that you have access to here at First Trade. So let's now talk a little bit about, once you're in a trade, how do you manage these trades? So this is really where there are 4 rules that I have for trading these options. The first rule we've already gone over, and that's that you want to collect at least 33% on the width. I think everyone, or hopefully at this point, everyone understands that rule and why it's so important, okay? But the next 3 rules are for managing these trades. So selling credit spreads, I will say probably the hardest part about selling a credit spread is just the management of it, because the first time you learn these rules, it sounds a little complex. But once you do this a few times, things will make a lot more sense. So there are 3 possible triggers that trigger the reason for you to get out of one of these trades. First rule is to exit the trade if you've made a 50% gain on the particular trade. So if you made 50% of what you can potentially make, time to get out of the trade. The second rule is a stop loss order. If you've lost 100% of what you can potentially make, time to cut your losses and move on. And the third rule is that if the trade that you've sold gets to 21 days to expiration without triggering either the stop loss or the take profit, that is also a time to get out of the trade. So first-time viewers, when they see this, they always get confused by this. So let me go through an example. Let's say I sell a $5 wide credit spread, just like in the previous examples, like in the ones that we did today. And let's say I collect a total of $2 in premium, right? So $5 wide credit spreads, I'm collecting 40% of it, $2. That means my max risk is $3 on this trade. So if I collect $2, what I want to do is if I sold something for $2 and it's now trading for $1, that means I've made a total profit of $1, which is half of what I can potentially make on the trade. That's the 50% max rule gain. So if I sold something for $2 and I can now buy it back for $1, that means I've made half of my potential profits, and it's time for me to take my profits and run. Okay, that's the first rule. The second rule is, if let's say I sold something for $2 and the trade starts to go in the opposite direction that I expect it to. So the value of the spread, instead of decreasing, starts to increase. Let's say it increases to $4. If something I sold for $2 is now trading for $4, that means I've lost a total of $2, which is 100% of the max gain. So if I sold something for $2 and now I have to buy it back for $4, that is the time where you can cut your losses and move on to the next trade. You don't want to let these go to the max loss. If you've lost 100% of the max gain, it's time to cut your losses and move on. And third of all, if it reaches 21 days to expiration and you have not reached either $1 or $4 on the trade, on the $2 credit spread that you've sold, it's time to simply exit the trade. And this comes down to avoiding assignment risk, avoiding the fact that you can potentially be assigned early, and maybe you don't even have the cash to be long or short the stock. So you want to avoid those by simply closing out these trades at 21 days to expiration, regardless of whether you're profitable or at a loss. Does that make sense? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so that covers the strategy itself. But there's one thing that I cannot stress enough, that even if you follow everything that I've just taught you here to a T, you follow exactly the rules that I showed you, there's still one rule that I think is more important than anything else with respect to building your account in a sustainable manner. And that is what we call the golden rule of risk management. And the golden rule of risk management states that you should never exceed 1 to 2% of your total account value in terms of a max risk on any single trade. So I have a chart here for you. Depending on the size of your account, you want to select max risks that are somewhere in this particular range. And the reason for this is because, statistically speaking, as you trade hundreds of trades, perhaps even thousands of trades, you're going to have a point in your career, and many times I tell investors, you should expect that in every single year that you're a trader, you should have at some point throughout that year where you're going to have about 6 to 7 losing trades in a row. And this is something that most investors think that won't happen. They think that, my strategy is good enough, that won't happen. And the reality of trading is that that will happen. It's almost a statistical guarantee that if you make enough trades throughout the year, you will have at least one instance where you have 6 consecutive losing trades in a row. And it doesn't matter how good of a trader you are, you're going to come across that. And the good trader, or the successful traders, are not the ones that are best at picking, which stocks to buy. They're not the ones that are, have the best rules rules that are better than you. They don't have indicators that are better than you. What they have is they have good risk management, so that when those series of 6 or 7 consecutive losses comes around, they don't blow up their accounts. They make sure that they maintain enough capital in their account to continue trading another day. What I tend to find most investors do is that string of 6 to 7 losses in a row that materializes at some point, for the investors that don't spend enough time managing risk and thinking about how much do I actually have at risk, those bad months result in a 30, 40, 50% loss in their total account value. And what they find is that after those types of losses, it's almost impossible to come back from without depositing more money in your account in order to continue trading. If you've went through something like that, please type yes into the chat window. I'm just curious to see how many of you have have experienced that, where you think you're doing well on trading, you think you've got a strategy down. Next thing you know, you've got this series of 6, 7, maybe even larger string of losers. And maybe it doesn't happen very often, but maybe it happens once a year, maybe once every 2 years. But it doesn't matter how often it happens. As long as if it happens even once and you're not managing your trades properly, your risk properly, you're going to blow up your account. And that is what most retail investors refer to when they say that they can't gain any consistency. They have these huge losses that put them so far back that they really can't continue to trade in the same manner they used to, or they have to deposit more money before they can. But the thing about professional traders is that there's a very easy way to prevent this. And that's to make sure that every single trade that you make never exceeds 1 to 2% of your total account value. So that even if you have 6, 7 consecutive losing trades in a row, that's 12 to 14% of your total account that's gone. But you still have 84, 86% of your total account value left to continue trading. That's how professional traders survive these downturns and continue trading for the long run. It's not that they have a superior strategy to you. It's not that they have better indicators to you. It's not like they have the ability to tell the future that you don't have access to. It's how they manage risk. And that is the most important rule of trading that separates professional traders from everyone else in the world. So what we have here in OptionsPlay are tools that are designed to help you stick to this rule. So what you do is you first have, first figure out what is 2% of your total account value. Let's say you have a $10,000 account. So the 2% rule is $200, right? What you can do is you can type this into your OptionsPlay account. We have what's called a risk and investment calculator. It's the third dot on the bottom of your screen, okay? And you can type in, how much am I willing to risk? Let's say you're willing to risk $200. Well, if you risk $200 and you click on calculate, here we go. As you can see here, it'll tell you you can only sell 1 contract of this vertical spread. That means you should never trade 2 or 3 contracts. I see a lot of beginners, they'll just always trade 5 contracts. Doesn't matter what trade they're doing. They just like to trade 5 contracts. Well, guess what? Some stocks are really high price stocks. You can't afford to do that. You must stay in your lane. So make sure that you use this tool properly and understand how much you're willing to risk. If let's say you have a $100,000 account, well, now you can risk $2,000 on a trade. Well, that's 7 contracts. Every single time you place a trade, you should use the risk and investment calculator and use the same amount every single time and let our platform calculate for you the number of contracts that you can trade. And then when you click on the trade button, when you hit preview order, it will pre-fill the contracts for you so that you stay in your lane with respect to risk management. So even if you listen to everything that I taught you before this one slide, and you listen to everything that I did and you sold credit spreads exactly that I told you to, but you've missed this last part and you don't follow these risk management tools and you just choose to trade 5 contracts here, 10 contracts there, whatever you kind of feel like or whatever you're used to doing, guess what? You're going to come across that string of losers. It may not happen tomorrow, may not happen next week, it may not happen next year, but you are going to come across it. And when that happens, if you blow up your account, it doesn't matter how much you gained before that. Once you blow up your account, you've blown up your account. And what you want to do as a trader is to make sure that you don't blow up your account. And the good thing is that it's really easy to do that. You just have to size your trades appropriately each time. Does that make sense? Please type 2 into the chat window if that makes sense to you. Okay, so that comes to the conclusion of what I want to teach you here today. So 2 things to remember. Number 1, trade simple and trade small. Credit spreads are simple strategies. They may seem a little complex at first, but hopefully I made it a little easier for you to understand, and make sure you stay to the 2% rule. If you stay to the 2% rule, you'll be able to, even if you have a string of losers, survive those losers and continue trading. That's how you build your confidence. That's how you grow your account. Make sure you have an edge using our credit spread report. Find credit spreads that collect closer to 40% of the width rather than just 1/3, which is the minimum. And I do encourage investors to learn to read the charts, because that's going to help you filter out some of those ideas. Not every single idea you come across you have to trade. Some of them you really like the chart setup. Other ones you say there are better chart setups for me to pursue. So this is a good way for you to learn which ones you really want to take and which ones you don't. That's how you can further improve your profitability. If you can have a good sense for the charts and get a sense for which chart setups look better versus others. And lastly, just practice. Understand your risks. Go through trade examples. Make sure you understand what I've taught you here today and apply them to the trades that you're making. The more you can trade, the more you can practice, especially small trades where you're not risking a whole lot. That's how you're going to be able to improve and then build your confidence and slowly grow your account. So with that, thank you so much for your time this afternoon. I hope that this was helpful in giving you a better understanding as to how you can use the tools available to you here at First Trade to accomplish the things that we taught you here today. With that, thank you so much. At this point, what I'll do is I'll open this up for Q&A. I have about 9 minutes to try to answer some questions. There's a Q&A section and a chat window here at the bottom. Please type your questions into the Q&A section, and I'll try to answer as many questions as I can. And remember, I cannot speak highly enough of First Trade taking the initiative and embedding these types of reports that OptionsPlay calculates for First Trade customers completely free of charge. This is really the only brokerage firm that I know of that has taken this initiative to take a lot of the data that OptionsPlay has and embedding it into the trading experience for you. This should make your trading options trading easier, much easier in terms of finding opportunities, analyzing them, and hopefully trading them in your own account. So with that, let's take a look at some of the questions. A great question here. So one question is, in the LI example, if the stock is at $24 at expiration, right? So remember, if the stock is below 20, he was basically saying, if the stock was at $24, what do you need to do? Well, first of all, before the stock got to $24, what would have happened is it would have triggered the stop loss. Whoops, sorry. The thing is that before the stock even gets down to $24, it would have triggered this rule. You would have lost 100% of your max gain. So that should have been your reason to simply get out of the trade. So first of all, you should never get to that. Second of all, the third rule, 21 days to expiration, also prevents you from ever getting to that. You should never be at the point where you're thinking about, at expiration, what do I do? Because you always manage these trades well before expiration. So hopefully that answered your question. But if you did find yourself at expiration in that example, then you should still close out your trade prior to expiration. You should never hold these trades to expiration. Do you suggest a standard increment between the short and long put? No. Always use delta to select your long put or long call strike. Never use a percentage or a dollar amount. Always use delta. Use a probability-based approach. How many sizes, sells and buys can we do in one day? So Sharina asked the question. So I tend to tell investors that you should never have more than 5 to 6 open trades at once. I tend to find that if you have more than 5 to 6 open trades at once, let's say you have 5 long trades, and let's say some macro event comes out, the Fed chooses to raise interest rates very suddenly, and the stock market dumps 10% as a result on that news. Now you've lost money on all 5 trades. Well, if that happens, you'll risk 10% of your account, right? If you stick to the 1 to 2% rule, 5 to 6 open trades at once are fine. You can have a little bit more if you sprinkle in longs and shorts, so that some of those trades will make some money, some of those trades will lose some money. That'll help balance it out a little bit. That means you can have a little bit more. But 5 to 6 trades if you're long only, maybe 8 or 9 if you're long and short. How many examples on stocks less than $50 like you suggested? Well, Kevin, you can sort this report based on stock price. And usually I tend to find there's at least 2 to 3 ideas for stocks under $50 each hour. This report is updated every single hour during the trading day. I think I've already explained delta. Delta is the probability of the stock being above or below the strike price at expiration. IV rank. IV rank is the implied volatility. It tells you whether the implied volatility of an option is relatively high or relatively low compared to its own history. Implied volatility goes from 0 to 100. 100 meaning it's the highest implied volatility reading we've seen over the past year. 0 is the lowest implied volatility reading we've seen over the last year. And it ranges from 0 to 100 in between that range. So it's a pretty straightforward indicator. Why are we going for 50% of max gain? Why not go for 80% of max gain? Great question. So once you've collected 50% of the max gain, the risk to reward. So at first, we're basically making 2 to risk 3 on a $5 wide credit spread, right? That's a risk to reward that generally works if you can win, let's say 65% of the time. But once you've made that $1, now, in order for you to continue holding on to that contract, your risk to reward now skews to $1 because that's the most you can make. Any more than that at that point, and the most you can lose is $4 if the trade starts to go against you. So once you've made 50% of the premium, the risk to reward starts to skew against you so that's why once you collect 50% of the max gain, especially if you have plenty of time, instead of holding on to it to try to make $1 extra, you're better off just taking that money and moving on to the next trade. Especially since now the risk has increased substantially. The risk has increased substantially and your new potential reward is substantially lower. So you do not recommend making any adjustments. So Ernesto, I generally do not recommend making adjustments. People do. I understand that people don't want to lose, but it's the wrong mentality I tend to find. I've worked with traders over the past 16 years, and the ones that spend all their time trying to, turn losers into winners are the ones that are focused on the wrong thing. I tend to find successful traders cut their losers. They focus on their winners. They say, okay, I've won on this particular trade. How do I turn this winner into a bigger win? Focus on adjusting your winners. Don't focus on adjusting your losers. Question based on your Tuesday morning market briefings. What data are you using to chart the market rotation? It's a proprietary company that does this. It's called RRG. They sell their charts to a lot of different charting packages like stockcharts.com, which is what I use. But it's a proprietary to a specific company. You can only get it through their approved vendors. How do you get to the chart screen, the OptionsPlay screen? Quick. So when you go to your home screen, as you can see here at the bottom, there's this Options Wizard button here on the right-hand side. You can also find it in the options. If you go to Trading and Options, there's Options Wizard here. You can launch it using that. If you're on the options chain, there's also an Options Wizard here. So there's a lot of different places that you can launch it from the First Trade platform. So the home screen and under Options Trading, you can launch it. Exit at 21 days to expiration means exit trade 21 days before expiration. Yep, Gregory, that's exactly what that means. So if the expiration that you're trading is 21 days from expiration, time to get out of the trade. Sun, thank you so much for your explanation. Can you explain a little bit more about exit strategy and OCO orders to control? So you can basically put in 2 separate orders, one order to a limit order and one as a stop limit order, one as your take profit and one as your stop loss. What I was showing you before, it's just what price you want to set your take profits at. So for your take profit, you will set it at $1. For your stop loss, you'll set it at $4. That's how you can make 50% of max gain or 100% of max gain. Do you need to have enough money in your account to cover both puts when you do a credit spread? Very good question. The question is, how much money do you need to place a trade? And the answer is the only thing you need in your account to place a trade. Whoops, sorry, I went a little too fast. What you need in your account to place every credit spread is the max risk. So every single credit spread has a max risk. The max risk is what you need in order to place that trade. So $310 per contract. If you want to trade 2 contracts, you need $620. So whatever the max risk, that is your margin requirement to get into the trade. Where is the exit button? Can you show us how to exit a loss? So I actually have a video on this, so you can go to firsttrade.com. If you go to firsttrade.com, go to research and tools and go to options wizard. I'll post this link into the chat window for everyone. But I do have a video on entering option orders and managing positions. So in that session, we talked about how to exit a position, exit a multi-leg position, how to do it on the platform, and how to do it on the mobile device. So both are available in that video. Your free contract rate is spectacular. What concern do we have around payment for order flow as the alternative? Is that business model at risk? Well, Bruce, I will say, payment for order flow for retail traders has really revolutionized the way that you guys trade options, because each trade you used to make cost you about $5 in commissions and then another $1 per contract in commissions. By moving to payment for order flow, effectively the market makers are paying your commissions. And I would say that it works out for everyone's favor. You know, your broker has to get paid at the end of the day, right? It doesn't matter whether you trade at First Trade or TD Ameritrade or anyone. Brokers need to get paid. The question is whether you pay that money or the market makers who make a lot of money pay you those fees. And payment for order flow allows a different person to pay for your trades effectively, because they can make money from your trades. And in exchange, you get lower cost trading. So it's a win-win, at least in my opinion, for retail traders. I certainly trade a lot more because of it. I used to not sell cover calls on stocks that I only own 100 shares of, that I was collecting, let's say, $40 in premium, because I was paying $10 in commissions on it, and it was eating away 25% of what I'm collecting. With payment for order flow, I mean, it was always there. It's just more payment for order flow now that that instead of paying $10 in commissions on that covered call, you keep all $40 that you're collecting. So I know there's a lot of controversy around payment for order flow, but I really think that it is truly a blessing for retail investors, because now you can trade commission free. Brett, thank you so much. I really appreciate it. I'll try to answer one more question. If selling credit spreads have much greater theta decay under 21 days, why focus on an arbitrary number? So Bruce, you're right. When you get into the last 3 weeks, you have higher theta decay, but you also have higher gamma risk. And that's really what I think most investors miss when they think about, oh, I want to get the most amount of theta decay. They think, oh, as long as I collect more theta decay, that's the better thing. But it's not like it's free money, right? It's not like it's a free lunch that, oh, I just want to sell 1 week options. I'll collect more money than if I sell 1 month options. The 1 week options have a lot more gamma risk. And that's what we find, that at 21 days, you have a trade-off between the acceleration that you have in theta versus the acceleration that you have in gamma risk. And we tend to find 45 days to 21 days, that holding period is the magic holding period where you have enough theta K, but very little gamma risk. Once you get into that last 3 weeks, yes, your theta K does shoot up, but the gamma risk actually shoots up even more. And that's why we always close out these trades 21 days from expiration. That is not an arbitrary number that we have chosen. So with that, thank you so much. I hope you guys have a great trading day. Best of luck to everyone. I hope that you are able to now use these reports that are available to you to find better opportunities for your options trades. With that, thank you so much and have a great trading day.